Hey everyone, welcome back to Accounting Basics. Today we're diving into the top 5 accounting ratios every stock investor must know. These aren't just random numbers, they're the building blocks of smart investing and can help you quickly spot strong companies and avoid the bad ones. Once you learn these 5 ratios, you'll be able to look at any company, Apple, Tesla, your favorite penny stock, whatever, and instantly tell whether it's financially healthy or heading for trouble. And by the end of this video, you'll know exactly how to calculate and use each ratio like a pro. Let's jump right in. The first and probably the most famous ratio is the PE ratio, which stands for price to earnings. The PE ratio shows how much investors are willing to pay for $1 of a company's earnings. In simple terms, it tells you if a stock is cheap or expensive relative to profits. How to calculate that? PE is equal to the share price divided by earnings per share, or EPS. I'll give you an example. Let's say company A has a stock price of $50 and its earnings per share are $5. So the PE ratio is 50 divided by 5 equals 10. That means investors are willing to pay $10 for every $1 of earnings. How do you use it? A low PE can mean a stock is undervalued or that the business is struggling. A high PE can mean strong growth expectations or that the stock is overpriced. Here's a pro tip. Always compare a company's PE to its competitors, the industry average, and its own historical PE. A tech company, let's say, with a PE of 30 might be normal, but an oil company with the same PE might be wildly overvalued. Next is the debt-to-equity ratio, one of the most important ways to measure financial health. It shows how much debt a company has relative to the money invested by shareholders. If a company has too much debt, it may struggle when interest rates rise or sales slow down. How do you calculate that? DE is equal to the total debt divided by the shareholders' equity. Example, let's say company B has $200 million in total debt and $100 million in equity. The DE ratio is 200 divided by 100 equals 2. This means that the company has twice as much debt as equity, which is a possible red flag depending on the industry. How do you use it though? So industries like utilities and telecom tend to have higher DE ratios. Industries like tech typically operate with lower debt. What you want is a manageable level of debt. A company drowning in debt can look profitable during good times, but fall apart fast during downturns. A pro tip, track whether a company's DE ratio is trending up or down. Rising debt over time equals a warning sign. Number 3, return on equity, or ROE. ROE shows how effectively a company uses shareholders' money to generate profits. It is a powerful measure of management quality. How to calculate that? ROE equals net income divided by shareholders' equity. For example, Company C earns $20 million in net income and has $100 million in equity. Your ROE equals 20 divided by 100, or 0.20, or 20%. This means that for every dollar shareholders have invested, the company has generated 20 cents in profit. Okay, so how do you use it? A high ROE, 15% or greater, is usually a sign of very strong performance. A low ROE may mean inefficient management or weak profitability. But here's the catch. A company can artificially boost ROE by taking on more debt. That's why you should always check ROE alongside debt to equity ratio. Here's another pro tip for you. Look for companies with consistent ROE over 5 to 10 years, not just a 1-year spike. The number 4 is the current ratio, which is a key indicator of short-term financial stability. The current ratio measures a company's ability to pay its short-term bills, things like accounts payable and upcoming loan payments. How do you calculate that? Well, you take your current ratio, which equals your current assets, divided by your current liabilities. For example, Company D has $300,000 in current assets and $150,000 in current liabilities. The current ratio equals 300,000 divided by 150,000 equals 2. This means that the company has twice as many short-term assets as short-term liabilities, a healthy sign. How do you use it? A ratio above 1.0 is generally pretty safe. A ratio below 1.0 means that the company may struggle to pay its bills. A ratio above 3 could mean that the company isn't using its cash efficiently. Pro tip, for retail or inventory-heavy businesses, also look at the quick ratio, which excludes inventory for a more realistic picture. And now, for number 5, one of the most underrated yet powerful ratios, free cash flow yield. Free cash flow yield reveals how much cash a company generates relative to its stock price. Since cash fuels dividends, buybacks, and growth, this ratio will help you spot true value. How do you calculate it? The FCF yield equals free cash flow divided by the market cap. Example, let's say Company E generates $50 million in free cash flow and has a market cap of $1 billion. So your FCF yield would equal 50 million divided by 1 billion, which equals 0.05 or 5%. How to use it? A higher FCF yield often signals an undervalued stock. A low or negative FCF yield can indicate cash flow problems. Many legendary investors, including Warren Buffett himself, focus heavily on free cash flow because it cannot easily be manipulated like earnings sometimes can. A pro tip on this one, compare FCF yield with the company's historical average, the risk-free rate, like treasury yields, competitors' FCF yields. This will help you to identify genuinely attractive opportunities. All right, let's have a quick recap of these 5 ratios. Number 1, the PE ratio. It tells you if a stock is expensive or cheap. 2, debt to equity ratio. Measures financial risk and leverage. 3, return on equity or ROE. Evaluates management efficiency and profitability. 4, current ratio. Checks short-term financial stability. And 5, free cash flow yield. It reveals the true value through cash generation. Learn these 5 and you'll understand more about any business than 90% of retail investors. If you found this video helpful, make sure to hit the like button for me, please. It really helps our channel grow. And if you want more investing accounting tutorials like this one, don't forget to subscribe and turn on notifications so you never miss a new upload. Drop a comment below. Which ratio do you rely on the most when you're analyzing stocks? Thanks for watching, and I'll see you in the next one.